Parrott, your host. All right, I want to jump back in. I got one last slide I want to get in with Phil while we've got him with us here. And let's get that up. There we go, Phil. In particular, talking about the effects here with bonds this year and how an unusual year this has been as far as the bond market.
Yeah, Hank, I think when we go back in the annals of time, we started this year with 10-year bond yields yielding 1.5%. The normal bond yield for the last 100 years has been about 5%. So what that means to everyone listening in today is by buying a bond and holding it to maturity, you had a 5% rate of return. That sounds pretty attractive, right, Hank? No, very little volatility.
Yeah.
Unfortunately, because the Federal Reserve was engaging in what's called quantitative easing, that was a byproduct of the COVID response. The Federal Reserve was the biggest buyer of Treasury bonds in the world, and that suppressed yields up until the beginning of this year, when the Federal Reserve started ending their quantitative easing program and formally ended it in March, Hank, we had an explosion up in bond yields. So normally when equities are down double digits like they are here, down 15% on the S&P 500 through mid-November, Hank, when you look at the chart on the left, normally bonds provide a hedge against equities, meaning there's what we call inverse correlation, meaning when stock prices are down, bonds provide a hedge or a ballast to the portfolio. That completely broke down this year for the first time in the history of the United States, and we've seen stocks and bonds down for 3 consecutive quarters. Why did that happen? Starting the year at a 150 yield on treasuries and then skyrocketing to 4% when the Fed abruptly ended their quantitative easing program, and we took the largest buyer of treasuries in the world out of the market through that process, Hank. We had to skyrocket. So what has that meant? It's meant this has been the worst year for government bonds since one of the worst years since 1700.
Wow. So
surprisingly, Hank, that the data goes back to the 1700s on global bonds. That's how robust this market has been for the last 300 plus years. And I think
that's a shocking part, Phil. I'm sorry, we're running short. Phil, I want to thank you for being with us today, and I'm going to get you back in as soon as we can, hopefully in the next few weeks, because there's so much going on right now, and in particular when we're leading up to that December meeting, I'd love to have you on to talk about what's going on once we get that November CPI and we get the MPC and the Fed meeting. So we'll have you back, and thanks again for joining us. And folks, one of the things I'm going to get real quick out there, if you'd like to get some more information, if you'd like to get some of the research pieces we've been talking about, call my office at 615-376-5325, 615-376-5325. Get that comprehensive plan at the same time. I hope this has been helpful for you this week and that you'll join us here each and every week on the Retirement Report.